This is a scenario of a lease under IFRS 16 leases, which has a period of the lease term paid in advance or prepaid prior to the commencement of the lease term. Payments are $100,000 a year, split into half-yearly payments of $50,000 payable on the 30th of June and the 31st of December of each year. The lease is for 5 years and commences on the 1st of January. 20XO. The entity and the lessor agreed in writing that the first year's worth of payments will be paid in advance prior to the lease commencement. The interest rate is 5%. The main question is, how do we treat the prepayment? We will figure it out by working our way through the example as per the standard. The standard says that these payments are to be considered in the determination of the lease liability: fixed payments, variable lease payments subject to a rate or index, residual value guarantee payments expected to be made, purchase option exercise payments, and termination penalties. In this scenario, we only have fixed payments. However, one thing we need to note is that the payments considered in the determination of the lease liability are only those that are not paid at the commencement date, as per paragraph 27. We will have to remember this for when we start putting together our schedule. Now, for the right-of-use asset, we need to start with our initial lease liability. Then we need to consider any lease payments made at or before the commencement date less any incentives received. Ding, ding, ding. This is where we need to include our prepayment, as we paid a year in advance before the commencement of the lease. We do not have any lease incentives to deduct in this scenario. We don't have any initial direct costs or dismantling and restoration costs estimated to be incurred over the lease term. With this in mind, we can now put our workings together. We will begin with the lease liability by preparing the payment schedule. Remember, we paid the first year in advance, and so we don't need to include anything here because the first two payments, being the first year's worth, are not outstanding as at lease commencement. We paid them prior to the lease's commencement, and so we can simply leave these as zero. From then on, we know our payments are fixed for the rest of the lease term, so we can simply fill the rest of the payments with $50,000 per half year. Similarly, as we have no payments, we have no discounting that is applicable, and therefore no discount factor for the first 2 half years. A brief reminder on calculating the discount factor. Refer to the IFRS 16 simple lease worked example for further discussion on this. For our periods with payments, we can calculate the discount factor. Note that the interest rate is aligned to the half-yearly payments for purposes of discounting. The interest rate included in the scenario details is an annual rate, whereas our payments are made half-yearly. As such, to discount them appropriately, we must have the interest rate of 5% to 2.5% for half-yearly discounting, i.e., 5% represents interest over 12 months. So to appropriately discount half-yearly payments, we need a 6-monthly rate. To get this, we can simply have 5%. We can then multiply our payments for each period by the relevant discount factor to arrive at the discounted payments, which when aggregated in total are the value of the lease liability at lease inception. Now we can consider the right-of-use asset. We can simply take the initial measurement of our lease liability. And as we determined earlier per the standard, we can add the amount of the lease payments that we made in advance, prior to the commencement of the lease. With our lease liability and right-of-use asset measured, we can then work out our schedules from which our journals will be based. For the lease liability, we begin with the value we measured. We simply add interest onto this balance for the period. We still do this despite no payments for this period being considered as part of the lease liability measurement, as this reflects the interest on all the other payments beyond this period, which were discounted. It is important to note that this interest is based on a 6-month interest rate. We simply took the annual interest rate included in the scenario details and halved it. If we applied the full 5% to the lease liability each period, we would be overcharging. We have no payments, so we include 0. We can simply follow this logic for the rest of the periods, now including our payments, which weren't prepaid. These payments reduce our lease liability. We know we will have prepared the table correctly when the closing lease liability is 0 in the final period. For our right-of-use asset schedule, we can start with our determined right-of-use asset value. Remember, this is the lease liability plus our prepayment, hence the difference in value to the lease liability. We can then deduct the depreciation expense. This is simply the right-of-use asset divided by the lease term, which in our case is 5 years. We are recording journals on a half-yearly basis in line with payments, and as such, we have 2 periods per year, giving us 10 periods. Similar to the lease liability, we can then follow this logic through for the remaining period. Our closing period from the first year becomes our opening for the second year, and so on. We know we will have prepared the table correctly if the right-of-use asset is 0 at the end of the lease term. With our schedules prepared appropriately, we can then look at the journals. For the purposes of this video, we will only consider the initial measurement journals as these contain the nuance relevant only to this scenario. The subsequent measurement journals will all be based on the schedules prepared. The logic taken from the IFRS 16 simple lease worked example video applies to these journals and can be used as a reference. The first journal, chronologically, would be our prepayment given we make this payment prior to the commencement of the lease term. This is simply a debit to our right-of-use asset, as we learned earlier, given its inclusion in the right-of-use asset valuation, with the credit to cash, payables, or the relevant expenditure or prepayment account, depending on the entity's accounting workflow. The next journal would be on lease commencement, where we recognize the lease liability and corresponding amount to the right-of-use asset. We simply debit the right-of-use asset and credit the lease liability. This entry is limited to the value of the lease liability, however, given this is the portion attributable to discounted lease payments outstanding as at commencement. If we were to review a trial balance at this point, our right-of-use asset and lease liability would match the opening balances on their respective schedules. Journals subsequent to these would simply be based on said schedules to recognize interest in payments on the lease liability and depreciation on the right-of-use asset. And with that, we finished our IFRS 16 prepayment worked example. Thank you for watching. If you found this helpful, please like and subscribe. If you'd like to see worked examples for other accounting topics, leave a comment down below. See you next time.